Good afternoon, everyone, and welcome to TBR Network's Infrastructure Services Research Highlights webinar. My name is Allison Crawford, and I'll be your host for today's session. Over the past year, we have engaged with our readers through our quarterly webinars to provide you with additional insight into the state of the networking and mobility market. We've had good questions and discussions with you, and we're excited to continue to connect with you as the NMP practice grows. Before I hand this over to Scott, there are a few action items I'd like to cover with you. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others that we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. Scott will address them at the end of the presentation. Or, if you'd like to set up a client inquiry for more detailed discussion, please reach out directly to Scott at the end of the webinar to set up that conversation. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight. And I'll be providing you with all of these social media links at the end of the presentation. With that, let me introduce Scott Dennehy, Senior Analyst on the Networking and Mobility team here at TBR. Scott has been working in the network infrastructure services space for the last 15 years and is leading our research coverage in NIS. Since joining TBR in 2010, Scott's insight has helped our clients improve their strategic go-to-market plans and market position. And with that, let me hand this over to Scott.
Thank you, Allison, and hello again, everybody. Just to let you know, I'm actually down in Las Vegas at the Interop show. So I apologize in advance if my connection here is cuts out at all, but they're looking forward to a good show and getting a lot of insight as far as what's happening in the enterprise market. But first, just to cover or to go over what we're going to cover from a high level in terms of the major trends and market drivers that we saw in the fourth quarter for the network infrastructure services market. As we've seen for the last few quarters, the market is certainly decelerating. If we look at the total NIS revenue growth for all of the 11 suppliers that we look at, that was in the fourth quarter, that was just over 2% year-to-year growth. So still some growth, but again decelerating, as in the third quarter that was 5.5% year-to-year growth and over 10% year-to-year growth in the second quarter. So again, still growth in this market, but it's certainly decelerating, and a lot of that has to do with the ongoing economic challenges that we're seeing in some developed markets and how the impact that's having on customer spending. This is something that we expect to see for at least the next quarter or two, although there are some indications that spending should start to loosen up a little bit in the second half of this year. Now, if we look at things from a vendor perspective, the equipment suppliers and the companies that I lump into that group are companies like Avaya, Cisco, Huawei, Juniper, and Siemens Enterprise. Overall, they fared better than their IT services firm counterparts, so companies like Accenture, Dell, Fujitsu, HP, IBM, and Infosys. And they were able to do that by squeezing some additional revenue out of their product-attached maintenance contracts. If we look at the revenue growth for just that particular group of equipment suppliers, they grew at almost 4% as compared to just under 1% for the IT services companies. Now, as customers deal with these smaller IT budgets, what we're seeing is that demand is growing or is being focused around solutions that help them reduce their costs or improve their operational efficiency and upgrade their legacy network infrastructure. And the advantage that provides for a lot of the equipment suppliers is that they're able to position their products that enable these customers to take advantage of some of these emerging technologies that do that. So things like cloud and mobility and SDN. So that's driving some of those product-attached maintenance and professional services revenues for the equipment suppliers. Now, from an IT services firm perspective, what we're seeing is this trend around these solutions is creating opportunities around in things like managed services. So companies that have strong managed services capabilities like Accenture, like IBM, even some of the equipment suppliers like Avaya and Siemens. They're well positioned here, particularly those that are able to kind of front end these managed services type of engagements with consulting and systems integration to provide that end-to-end type of solution. So looking at things from a regional perspective, and the title of this webinar was kind of the race to the emerging markets, and that's really what we're seeing and continue to see within NIS as far as the focus of these vendors geographically. Regions like Asia Pacific and Central and Latin America in the fourth quarter had the strongest NIS growth in the fourth quarter, primarily due to that rapidly growing economies in some of those key emerging countries that I'm sure you've all seen and heard talked about, like China, like India, like Brazil, and like Mexico. Now that said, even though those countries continue to grow, as you might expect, the competition in those countries is heating up. So now what we're also starting to see now is some of these suppliers start to focus on these kind of second-tier emerging countries like Peru in Central and Latin America and some regions in Southeast Asia in the Asia Pacific region. So before we get into some of the specifics around the segment and geographic results, I just want to kind of level set on what we look at within NIS for some folks that maybe haven't seen this webinar before. So what we're after here is really isolating the services around that network infrastructure layer. And I think the best way to think about that would not necessarily focus so much on what is covered, but what isn't covered. So what we don't include as part of network infrastructure are things like endpoint devices, laptops, and tablets. We don't include servers and storage in the data center. We don't include enterprise software, so whether it's CRM or ERP, supply chain type software, productivity software, really just trying to isolate that network infrastructure and any software that's associated with that network infrastructure, either from an operating system perspective or from a management perspective. So we've got 11 vendors that we look at, a good mix of traditional equipment and hardware vendors and IT services firms, and I'll talk a little bit more about them in just a second. 4 main services segments. You see some of the individual subsegments within professional services there, and 4 geographic segments. What's also important to understand is that we do not look at the telecommunications or communications vertical. So we don't address services sold to companies like AT&T and Verizon. So we're really trying to isolate that enterprise segment. We have another practice within TBR that addresses what we call the telecom infrastructure services, or TIS segment. This is focused on just those enterprise customers that aren't telecom suppliers. So some of you who have been on the webinar before have seen this slide, but for those of you who haven't, this is we look at the 11 vendors that we cover in terms of their strategy and how they approach this market. So on the left you have those equipment suppliers that I mentioned, and on the right side you have the IT services firm. Kind of where they fall on this scale really determines what their approach is and how they go to market, as well as what their NIS revenue mix kind of looks like. So on the left you have the equipment suppliers, as you might expect. Their approach primarily is leading with product and then attaching services, particularly maintenance services, onto those product sales. And as you might expect, their revenue mix is much more heavily weighted on maintenance services. On average, these suppliers get over half of their total NIS revenue from maintenance. On the other end of the scale, you have the IT services firm, where it's almost the exact opposite approach. It's a services-led approach, and then product comes along with that depending on the solution that's developed through the course of delivering those services, whether they're consulting or what have you. And as you might expect, their revenue mix tends to be more heavily weighted on professional and managed services. Only about 20% on average of these vendors' NIS revenue comes from maintenance. So maintenance is certainly part of the portfolio, but it's more about delivering an end-to-end solution. Their preference is to sell more of the professional and managed services, as you might expect. Now, what we are seeing happening is a lot of these vendors, if you look at the scale, are really trying to move from left to right and become more services focused. It's clear that from a long-term perspective, hardware is becoming less and less important as technologies like cloud start to develop and gain adoption, and SDN is starting to emerge. So a lot of the equipment suppliers are looking at services as really a growth driver for them and starting to adjust their strategies and start to behave more like the IT services firms. Again, I mentioned Avaya and Siemens. They have very large services organizations. In fact, in both cases, about half of their total revenue, total company revenue, comes from services. So they're very focused on the services market and are continuing to invest in those capabilities. And you're seeing companies like Huawei and even Cisco start to move in that same direction. So over time, you're going to start to see a lot of those equipment suppliers on the left start to move to the right and look more at services as a key driver of their long-term revenue growth. So if we look at this market from a total revenue perspective, and just a word on how to read these bubble charts here, because you're going to see quite a few of them. Obviously, the total revenue for either the segment or the geo is going to be on the bottom there, revenue growth on the left, and then the size of the bubble kind of indicates that total revenue to give you a visual idea of how these vendors compare to one another. But if we look at this market as a whole in the fourth quarter, as you might expect, Cisco still maintains that dominant position because of their market share position within the enterprise network, that really strong channel partner base. They're driving a lot of the product and services revenue through. They continue to dominate in terms of total revenue. Huawei was the highest growth generator for the fourth quarter, and you'll see them as in that position for a lot of the individual segments as well, even though they're still coming from a relatively small base. Now, as I've talked about in previous webinars, Huawei is very focused on the enterprise market. They're investing very heavily. Now, they've had some very ambitious goals over the last couple of years and have been falling a little bit short of that. In fact, their total enterprise business revenue growth for the full year 2012 was only about half of that growth in 2011. So they are decelerating a little bit, particularly as that install base grows. However, they've got a good, solid foundation in place now for which they can scale up their volumes, and we expect them to continue to generate very high revenue growth in NIS as we go. Now, speaking about Cisco again, as I mentioned, services is becoming more of a focus for them, so we expect that NIS will become an increasingly larger part of their revenue mix. Now, a company like Juniper, in terms of those that are lagging the market, Juniper was, I believe, third last quarter in terms of revenue growth, but you can see that they really fell behind this particular quarter. A lot of that has to do with the fact that some of the weak spending that I talked about earlier, particularly in some key markets for them, like public sector in the U.S. and like financial services firms, really hurt their revenue in the fourth quarter, as they're very heavily concentrated in those two verticals from an enterprise network perspective. Looking at NIS operating margin, what's interesting about this market and the vendors in it, there's really no clear approach or clear strategy that drives the operating margin for a lot of these vendors. You've got companies like Juniper and Cisco that a lot of what they're able to do from a margin perspective comes from the fact that they generate 75 or 80% of their NIS revenue from maintenance. But there's other companies that have high maintenance, or a lot of their revenue comes from maintenance as well, but they've got lower margins. Huawei is an example, Avaya is an example. So a lot of it depends on what their approach is and how they're focusing on the market, whether it's from a go-to-market strategy or what have you. Infosys, I've talked about before, as far as their focus on really high-end opportunities and high-margin opportunities, really drives their operating margin. Their margin has come down a little bit recently because they've really more been focused on growth, but as their growth is starting to take off a little bit here, we expect them to make some adjustments to try to continue to keep those margins at a high level. There's some other firms, particularly on the services side, companies like Dell, which are taking more of a vertical type approach and developing what I would call a vertically integrated operating model. And that lets those companies pursue higher value, higher margin type deals. But as you might expect, there's really a lot of other things that these companies are doing to drive their margin, whether it's service automation in the case of a company like Cisco, whether it's corporate realignment that we've seen from Juniper over the last 6 months to a year, IBM, and I'll talk a little bit more about them as far as restructuring some of their lower margin contracts, and in cases like Avaya and HP, it's just straight headcount reduction to try to get those expenses down and get those margins up. Turning to some of the individual services segments that we looked at in this benchmark, first maintenance. Total maintenance revenue for the 11 vendors grew just over 2.5% year to year, on par with what we saw from the total market, as you might expect, with most of the revenue in this coming from maintenance. However, a lot of the suppliers were hurt by what I talked about earlier as far as conservative spending in some key markets like the U.S. public sector, with some vendors more exposed than others. I mentioned Juniper. Avaya is another company that really felt the sting of the public sector slowdown and some of the conservative spending that continues in that market. I mentioned Huawei before. Again, they're the growth leader here. A lot of that driven by the fact that they continue to build out their enterprise product portfolio, attaching maintenance services to those. In fact, at the end of last year, they launched a set of maintenance services, basic maintenance services that are specifically designed for enterprise customers, including things like basic remote and on-site support and online support portal. So that's going to drive some of their maintenance revenue growth as we move through 2013. Deployment services. Deployment was actually the highest revenue growth generator of the 4 segments, just over 3.5% year to year. A little bit deceiving in that a lot of that was driven by the fact that customers spent what was left of their budgets for 2012 on kind of short-term projects. So that really boosted a lot of the revenue for a lot of these suppliers. That said, deployment still remains the lowest in terms of the revenue share for most of these vendors. Only about 6% of total revenue for these suppliers comes from deployment services, and a lot of that, as I've talked about before, has to do with the fact that most vendors, with some exceptions like Huawei, really leave a lot of the lower-end, low-margin deployment opportunities, basic installation, basic implementation, to their partners, and instead focus more on those high-end opportunities that require their particular expertise. So that lets them keep those margins high, avoid channel conflict, but from an overall revenue perspective, the volume is low. Now, looking forward in terms of what's going to drive a lot of the deployment revenue for these suppliers, emerging technologies like cloud, like mobility, we're starting to see SDN start to take hold, and that's going to be another piece as we get towards the end of the year and we start to see a lot of SDN-type deployments. That will drive a lot of the deployment revenue for most of these suppliers. Professional services. Now, professional services struggled during the 4th quarter, growth of just about 1% year to year, as that economic uncertainty in a lot of those developed markets really caused most customers to focus on cost control and cost takeout. So the professional services opportunities that a lot of these suppliers saw is really about short-term, what I would call kind of run-the-business type engagements, rather than those longer-term kind of transformational type engagements that really drive a lot of revenue for a lot of these companies, particularly like Cisco and like IBM. Now, as we move through 2013 and some of these emerging technologies that I talked about, cloud mobility, UC, FDN, as those start to continue to gain momentum, that's going to drive a lot of professional services, particularly around consulting and systems integration for a lot of these vendors, as customers will need guidance as far as how to deploy these technologies into their networks. Cisco UC generates a lot of revenue in professional services. They're investing very heavily in their consulting services in areas like cloud, like security, like mobility, and focusing on some specific vertical markets like healthcare, really being a big one for a lot of these vendors, Accenture being another, as far as a vertical approach to professional services and really where the bets are being made. Managed services. Last quarter, managed services was the highest segment in terms of year-to-year growth at about 10%, but even managed services wasn't immune this quarter to that slowdown we saw. Came in about 3% growth for year-to-year for the fourth quarter. Still a lot of opportunities that are being created if you look at customer needs around cost reduction, operating efficiency, and kind of reducing that network complexity it remains a key driver of managed services growth as customers get more and more comfortable with turning over the operations of their network to a vendor. As more of these technologies get deployed, more vendors get deploying these networks, it's just making more and more sense for enterprise customers to let a vendor who has the capabilities to manage all of that rather than investing in their own IT functions and own staff to try to keep track of all that and keep up to speed with the rapid changes that are taking place in these enterprise networks. So as a result of that, we expect managed services to become a much larger contributor of NIS revenue for a lot of these suppliers, including some of the equipment vendors as they look to see how these opportunities develop and use kind of their product expertise to deliver managed services both directly to customers and through partners. If you look at the leaders from a growth perspective, Dell, the growth leader here, and Dell's being very successful with positioning their managed services around really a couple of key areas, bundling their networking with their server and storage solutions around the data center as being a big driver for them, as well as security. Their SecureWorks portfolio has really been bolstered by the SonicWall acquisition that they made earlier last year, and enabling them to focus on things like managed security services. So security, a key focus area for Dell in terms of managed services and becoming a bigger and bigger driver of their growth. I mentioned IBM earlier as far as restructuring their low-margin contracts, and managed services is really a key area here, particularly around outsourcing. So that's hurt their revenue growth a little bit, but for them right now it's really about margins and keeping that margin growth momentum. So we're going to continue to see that. So for them, again, it's not really about revenue growth so much as it is about margin. So from a managed services perspective, that's a key area where we're seeing them restructure a lot of those low-margin deals to try to get those margins up. So we can turn to the geographic views now. Again, we look at 4 geographies within the NIS market. North America is still the largest in terms of revenue volume, but on the lower side in terms of revenue, just over 2% in the fourth quarter. Again, a lot of that stemming from the kind of elongated decision cycles from the U.S. government. Even though the fiscal cliff situation had been settled and the election got, or the presidential election took place in November, there was still a bit of a hangover that carried through the end of the quarter in terms of uncertainty and making U.S. government customers think about the spending that they were making and being more hesitant to do that. So that was really a big factor in the revenue for a lot of the suppliers, particularly those that I've talked about already that have a very heavy concentration in that market, Juniper, Avaya, HP being another. Now, some suppliers, particularly those that are based outside of North America that are really working on their brand recognition and investing in this market, Siemens being one, Fujitsu being
Hi, folks. This is Allison. I think this is one of the problems Scott had mentioned might happen. Let's just wait a second and see if his phone comes back.
Hi, sorry about that. My phone cut out on me. Hopefully everybody can hear me now.
Yep, we can hear you, Scott. Thanks.
Oh, great. Thank you. As I was saying, some of the foreign suppliers that are investing in North America, as spending starts to loosen up a little bit towards the end of the year, they should start to see some of the benefits of those investments and capturing some of the revenue opportunities that are going to be created. Now, in terms of North America, one of the more interesting vendors is Huawei, obviously, because of what's happened with them in some of the reports that have come out from the U.S. government and where their brand is in terms of the U.S. market. Some of you may have seen a couple of weeks ago that Huawei came out and said that they were pulling out of the U.S. market. A lot of that is more to do with their telecom business. So even though that certainly will have an impact on their brand overall and certainly on their enterprise business, we still expect them to be very heavily focused on the U.S. market from an enterprise perspective. And I certainly don't expect I don't expect Huawei to disappear completely. In fact, I expect them to continue to be or at least continue to invest in the U.S. market and try to build up their brand and their customer base. So turning to EMEA, a flat year-to-year growth for the fourth quarter, lowest of all the regions. Again, the issues that we're seeing in Europe, particularly Western and Southern Europe, continue to impact a lot of the vendors. Europe is certainly one of those where looking at areas like Eastern Europe, the Middle East, and Africa, where the emerging markets play is really key for a lot of these suppliers. IBM being one of them. They're continuing to expand their presence in Eastern Europe and the Middle East. A couple of countries that they've expanded their presence in recently are Turkey, Morocco, and Poland, where they opened up all branches during the fourth quarter of 2012. So we expect to see IBM continue to invest very heavily in these emerging markets to help offset the weakness that they're seeing in the developed markets. Asia-Pac was the second highest in terms of revenue growth, just over 5% year-to-year. In fact, all of the 11 suppliers that we look at in the benchmark grew their revenues during the fourth quarter. It was the only region to do that. Again, a lot of the drivers there is around network modernization, network upgrades in some of those key countries like China, like India. Central and Latin America was the highest revenue growth, had the highest revenue growth, about just over 6% year-to-year. However, that overall, as you can see from the bubble, overall revenue share remains the lowest. And I mentioned earlier about some of the second-tier countries like Peru. Obviously, Brazil and Mexico really still the major ones. If you look at things from an overall regional perspective, are really key. But countries like Peru, Argentina, these are starting to emerge as kind of those second-tier countries. And it's really those companies that have the ability to quickly move into some of these new markets. IBM, Accenture, Cisco, HP, even Siemens we're seeing investing very heavily in new personnel, in partnerships to try to localize their position within these markets and capture the revenue opportunities as they emerge. So that's the end of the material in terms of the fourth quarter results, but I just wanted to quickly touch on the benchmark in general. Obviously, here you're seeing the highlights. The syndicated benchmark that we publish every quarter is much more detailed. We go into much more detail in terms of financials. We do an analysis of each of the top 3 suppliers in every service category and in every region that we've covered. Much more deeper insight into the vendor strategies and some of these market trends. So again, more highlights here, but a much more deeper view in terms of the syndicated product. And if you've got questions around that, I'm certainly happy to answer them. So with that, Allison, I'd like to turn things over for questions.
Sure. We had 2 questions come through so far, Scott. The first question is, could you talk more specifically about how Huawei's decision to pull out of the U.S. will impact their enterprise business?
Sure. Yeah, so as I mentioned, and I think pull out was probably a bit of a strong term, and again, for them, it's mostly their telecom business. They do have, as you probably know, back in October, the U.S. government came out with a report that said that Huawei was a security risk to U.S. national security. And really the concern for the government is having Huawei gear that's powering telecom networks that span the entire country. So you've obviously got a lot of data that's moving back and forth across these telecom networks, and the concern there is that having Huawei's telecom gear running a lot of that obviously exposes the U.S. to some security risks. It's a little bit different on the enterprise side because you're talking about enterprise networks that are a little bit more self-contained and that are a little bit more specific to individual companies. There's still a bit of a risk there, but I think the trouble that Huawei's been having has really been on that telecom side. They've been investing very heavily in the U.S. market and trying to break into the market for some time, but I even think they're recognizing that they're not getting the results that they want and that they kind of have to regroup a little bit and figure out a different way to penetrate that market. So as I said, that's certainly going to have an impact on their enterprise business, particularly from a brand perspective. I think it's going to be more difficult for enterprise customers to justify having Huawei in their network if the U.S. government is coming out and saying that they're a security risk. That said, I think Huawei themselves hasn't given up. I think you're going to see them shift their strategy a little bit and focus more on specific verticals that might be a little bit more open to having them in their network. The education market is one of those verticals. So I certainly don't expect them to completely pull out of the market or at least lessen the investment as they are on the telecom side. I expect the U.S. enterprise market to still be a big focus for them, but it's certainly not going to get any easier for them given what's happened with them on the telecom side.
Okay. We have one more question so far, so if anyone has any questions on the materials Scott has presented, please send it through now. The second question we got, Scott, was which telecom providers are most active in this market?
Okay, yeah, so for telecom providers, thinking about companies like Verizon, like AT&T, BT Global Services, Orange Business Services, a lot of these, you can think a lot of these companies very similarly as IT services firms as far as how they're approaching the enterprise market. Big difference being they have network assets that they can use to deliver network type services like voice and data, cloud, some of those kinds of things. I think by and large, if you look at the U.S. market, a company like Verizon, it appears to me as though they're starting to de-emphasize the hardware side of things as things move towards more of a cloud model. So what that means is they're become less and less of a resale channel, if you will, and less focused on things like maintenance and services around gear that is installed at a customer site or a customer premises. They're clearly moving away from that and moving more towards a hosted or a cloud model. That said, there are some operators that are still very heavily focused on this market. I think Orange Business Services is one of those. BT Global Services is one of those. They've got very strong partnerships with companies like Cisco, like Juniper, like Avaya. So even though those companies are certainly investing in cloud, and I think as the market moves away from a hardware model, you'll probably start to see them emphasize it less and less. But for the time being, those are the companies that are still focusing very heavily on that market. So from a competitive perspective, those are the types of companies I would expect to see, in some of these customer accounts, driving sales of gear and the services around that gear.
Great. Doesn't look like we've had any other direct questions come through, Scott. So with that, I think we can feel free to wrap up. I want to thank those of you who did send through questions. You can follow Scott at his Twitter handle listed here. You can also follow TBR at TBR Inc. on Twitter. And the two channels that you should be aware of are YouTube, which is TBRI channel, as well as our SlideShare, which is TBR_market_insight. So we encourage you to join us on social media to check out what we're working on, both in the NMP practice as well as TBR overall. Before you guys log off, I would like to encourage you to take a brief survey at the end of the webinar. We'll be gathering your feedback on the quality of the presentation as well as the presenter to improve from quarter to quarter, as we want to make sure that we are providing a valuable service to you. So it's just 3 quick questions, and we appreciate your feedback. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute questions you guys have, or you'd like to set up a conversation with Scott, or if you're going to be at Interop and would like to meet him for a drink, you can also do that as well. If we don't hear from you, we look forward to hearing from you guys all again next quarter, and have a great afternoon. Thanks, everyone.